Hello guys, my name is Prosper Okonkwo, bringing you Forex Mentorship course from FSpreneur Global Forex Trading Academy. We'll be looking at liquidity. What is liquidity? If smart money wants to buy a currency pair, they will need sellers in the market. The existing facility to place these positions in the market is called liquidity. Liquidity is defined by stop losses. Where the stop losses exist is where the liquidity also exists. Smart money needs to activate stop losses of existing orders in the market so that they can place their positions in the market. When the market moves, there is no random movement in the market. Every movement in the market is predetermined, is thought after. And there are certain factors that attract price to a particular area. One of these factors is liquidity, which is basically where you have accumulation of stop losses. Because every setup that presents itself also shows or gives you the particular area on the chart where your stop loss is supposed to be placed. So this accumulation of stop losses forms liquidity. And these market makers, they need to activate this liquidity before they move the market because they are targeted towards the money. Market makers, their eyes are focused where the money is. And where is this money? This money is found where you have stop losses accumulated. There are three types of liquidity: buy stop liquidity, sell stop liquidity, trend line liquidity. Buy stop liquidity is originated by stop losses of sell orders. That is where the stop losses of those who sold, where the stop losses of sell orders are accumulated, are referred to as buy stop liquidity. And after buy stop liquidity is taken, the market reverses to the downside. So when buy stop liquidity is being taken out, the market reverses to the downside. And where can you find these stop losses of sell orders? You have to find these stop losses of sell orders where at the exact point or above the point where sell setups, above the point where sell setups appear. About the point where sell setups appear, this is where you have this buy stop liquidity. That is where you have the accumulation of stop losses of those who sold. So what to focus on for buy stop liquidity? You look at the previous day's high, the previous week's high, the previous month's high, initial high of the day, equal highs, talking about your double top, your regular resistance. These are the areas where you can find buy stop liquidity. Now, looking at this chart here, you have this particular month. This was the high for the month. Then the next month, the market opened. Then look at this. This high was taken out by this particular high. This high here took out this high. So this particular high at this point have stop losses accumulated around it. Stop losses are accumulated around it. And when the market opens on the next month, the high was taken out with this movement to the top here, which is exactly what you have here. So previous month's high are where you have your buy stop liquidity. And for market to move, market has to go take out this liquidity, then reverse. I'm going to pull up a chart to explain everything about liquidity. Here we have a chart of Euro USD. Okay, now on this particular day, now this is the beginning of a week. Today is actually Monday, beginning of a week. So this is the beginning of the week. So this was Friday, the end of last week, Friday. And in the same last week here, we have Thursday. This day is Thursday. This day is Wednesday. This was Tuesday. And this was Monday, beginning of the previous week. So on this particular week, the high of this week this is the high of this week, of the previous week rather. This was the high of the previous week. And this was the low of the week. Now on this new week, today being Monday, the market opened and took out the high of the previous week. Took out the high of the previous week with this move. With this move here. This move here took out the high of the previous week, forming a new high, which in this point, today is the first of the week, which here gives us the high of the day. Now, if this high remains to the end of the week, this high remains without being taken out to the end of the week, it can actually be said that this is the high of the week. And if you look at here also, you're going to find that what we have here is a liquidity here. The liquidity here, which is an equal highs. Look at this first high, second high, third high. These are equal highs. Now this move here to the top to form the high of the day, when was done, it's in the intention to take out this particular high at this point. With the intention to take out this high, starts forming the high of the day. And you can see how the market made a move down afterwards. All right. Now, if you look closely here, we're going to see again another low, equal lows here. This is liquidity. Where you have equal lows here, this is liquidity. All right. That is liquidity. Equal lows. Equal lows represents sell stop liquidity. Sell stop liquidity. Sell stop liquidity which is found where you have the accumulation of stop losses of buy orders. Where you have the stop losses of buy orders is being referred as a sell stop liquidity. The way where you have the stop losses of sell orders, this is where you have the buy stop liquidity. And once the buy stop liquidity is taken out, once it's taken out, the market reverses to go short to the downside. And for sell stop liquidity, once it's taken out, the market reverses to go to the upside. Now, if you look closely, you can see that this liquidity down here is yet to be taken out. Now, if price makes its way down to this liquidity here, it is heading to this order block. Now, one thing you should know is this. Whenever you find the liquidity, there is an order block after that liquidity. There is always an order block after the liquidity, because the market do not just take out the liquidity and stops halfway randomly. No. Remember that every movement you see out there in the market is a predetermined movement. The market do not just take a liquidity and stop halfway. Now look at this particular liquidity here. When it was taken out, market tapped into this order block. This is an order block that is yet to be mitigated. Market price tapped into this order block. It was intentional. The intention was to take out this liquidity. But when this liquidity was taken out, price referenced this order block. This order block was referenced before price started to make its move to the downside. All right. Now, coming down here, this is under liquidity. Because liquidity can also be, we have the buy stop liquidity, the sell stop liquidity, and the trend line liquidity. All right. So liquidity can also be in a trend line. Yes. Liquidity can also be in a trend line. This is a liquidity here on this trend. All right. Remember, to draw a trend line, you need 2 swing points. All right. This is our swing high. This is the first swing high. This is the second swing high at this point. right? The third touch on this trend line simply confirms this trend. Now, this is the liquidity, okay? Now, for retail traders, retail traders will be expecting to do this. Now, price heading towards this trend line, retail trader will be expecting to buy from here to go up. Good. Now, for smart money trader, you don't do that. You have to wait because we understand that this is a liquidity. There are stop losses accumulated below here, right? So these stop losses has to be taken out. And what is the point of reference here? Once these stop losses here are being taken out, the price will not just reverse halfway. Price will simply reference to this other block here. Reference will be made to this other block. Now, if this other block here could not hold the price, the market will make its way further down to achieve two purposes. Look at it here. Two purposes. Now, when you look down towards the left-hand side there, below this liquidity, there is a fair value gap here. There's a fair value gap here that is yet to be filled. Now, this fair value gap is what will attract price to the downside. And when this fair value gap attracts price to this downside, price will reference here to mitigate this other block. Now, remember, there are two things bringing price to the downside. Two things. One is this liquidity. And when this liquidity is being taken out, another thing is attracting price towards the downside, which is this FVG here. Now, once this FVG is being taken out, price will reference this other block. It will reference this other block, then probably give us a 50% retracement. 50% retracement to make its way down. Now, why am I talking about making a move to the downside? Why am I talking about a move to the downside? Now, I'm talking about a move to the downside because of this. Because as traders, we need to understand or how to read the chart clearly. All right, the chart reading has to be crystal clear to you. You need to understand exactly what you are doing. You may not have the kind of money the market makers have, but for you to trade along with them, you need to understand their signatures and what they look out for. And what are the things market makers look out for? The smart money traders, the banks, what do they look out for? They look out for three things. One, fair value gap. And for you to have a fair value gap, there has to be an order block before the fair value gap. Then the second thing is liquidity. Their eyes are always on the bag, on the money. All right. Now, liquidity is the money. So as a trader, you need to be able to spot out and identify these liquidities, else you will become the liquidity. I repeat, you need to spot out the liquidity, else you become the liquidity. Okay. So there is an FVG here to be filled. This is what will attract price down here. Now, I'm not saying that this is going to happen instantly, no, but definitely price is coming down because of this fair value gap. And after the fair value gap, you're going to find an FVG here. Sorry, after the fair value gap, you're going to find an order block. This is an order block. And right by the order block here, there is a liquidity. There is a liquidity. All right. Now look at it here. We'll take this chart towards the left-hand side. Let me zoom out. Or rather, let me take this chart to 4 hours time frame. Then 4 hours time frame and zoom out. Zooming out, we have a trend line liquidity. We have a trend line liquidity. We have a trend line liquidity. You can see they have a trend line liquidity. All right. So whilst price is coming down, now price is making its way down to take out or to clear off that FVG. First is coming this way, clear this liquidity, reference this other block, do a pullback, come down here because of this fair value gap, cover it entirely, reference is trade into this other block, give us a 50% retracement, then come back down to fill up this FVG. Now to trade into this other block, depending on the time it gets here. In doing that also, there is a liquidity here to be taken out. So price takes out this liquidity, which simply means trading into this particular order block. It's very simple. Wherever you have accumulation of orders, which will precede a stop loss, there are liquidity. There are liquidity. And liquidity can come in the form of one, um, um, the buy stop liquidity, talking about the previous day's high or previous day's low, previous month's high or previous month low, previous week high or previous week low, initial high of the day, initial low of the day, your equal highs, talking about your resistance, your double top, your equal low, talking about your support, and your double bottom. And also note that liquidity can also come in the form of a trend line. Can also have a trend line liquidity. So as a trader, when you're mapping out your order block, you're looking out for FVGs. FVGs is what will attract price to that order block that is yet unmitigated. And when looking out for that, looking at price movement, you also watch out for liquidity, spot how that liquidity is. Because the market maker will always go for the money. Don't play by the rules. All right. They have their eyes on the money. So they will always go for the money. So where the money is where you have your liquidity. And liquidity must definitely be cleared off before price movement. So this basically explains everything we have here. Here you can see the previous high. Initial high of the day was formed here. It was the initial high of the day. But price came back and grabbed the liquidity, cleared all that liquidity, taking out the previous high. All right, and you see how this is a buy side liquidity, and price make this way down to take out this make this way down with the intention to take out this particular low. Okay. You can see what we have here again. We have equal highs here. We have equal highs here, and you have a previous high. So when price made its way to the upside, it took out these equal highs. Of course, I saw under preceding old high here, took it out. All right, so liquidity was grabbed. And you can see how the market did a very swift reversal downwards in the aim to take out this particular low. This sets the liquidity, talking about where you have the accumulation of buy orders. We have the buy orders, you have the set stop liquidity there, which has to do about the previous month's low, previous week's low, previous day's low, initial low, equal lows. All right. Here you have the initial low of the day. The price swing low and took it out. And afterwards, you can see how the market made a very swift movement to the upside, taking out this high. You can see that here. An initial low was formed, a stop hunt to take out that previous low. The stop hunt to take out that previous low, that is the hunt for liquidity. Price made its way up, taking out this high. All right, price made its way up and made its way up, clearing this particular high over here. Here's another chart that explains that. You can see that the market always goes for liquidity. Now, this is another chart here to throw more light on the point, talking about liquidity. Here, we have a swing low. Then there was a change of character. All right, when price broke this initial high, all right, a change of character here. We return to other block. Okay, now when market broke through this previous high there, giving us when the price broke to this high, giving us a change of character to the change of trend, character to the upside. Here we have because of that, market range around here and around there, giving us a range. Here we have a liquidity to the upside, a liquidity to the downside. Then price return back down to this other block. Return back down to this other block. It took out the liquidity to the downside liquidity, then reference the other block, then made its way up here, taking out this liquidity to the upside, this buy stop liquidity to this up. The market range around here. But in the course of going up, you can see that price left a whole lot of FVGs, fair value gaps around here. And these gaps have to be filled. Now, if these gaps are filled, price will reference the other block here. Sorry. There's another block here, which price will reference to. Okay, now we have averages to be filled. Then price came down here. Okay. Price went this way to the downside here. Then there was a range for some time. Now this range gave us, what do we call it? We have here, this range gave us equal, a triple top here. First top, second top, third one, then the triple bottom. These are your equal lows. So have liquidity to the up and to the downside, all right? Whereas the movement down covered this FVG towards this way. This FVG was cleared towards that way. And after the mark after price range, it made a movement to the downside, tapped into this other block. All right, but in the movement down, price also left fair value gaps around here. All right, which has to be filled. Which has to be filled. Then this issues a range around there, which gave us equal highs to this side, equal highs here, equal lows, equal lows. These are liquidity that needs to be taken out. Then price made its way to the upside. You can see a movement to the upside here, to the upside. This movement we are done to fill off this FVG. Now these FVGs we are covered up here. Then price went up, referenced an other block to the upside, which was yet unmitigated, and mitigated this other block. Now, when this other block was mitigated, there was a change of character to the downside. All right, there was a change of character to the downside, giving us a failure swing. This gave us a failure swing, or a sign of weakness to the upside, then a reversal to the downside. But there is something I want us to see in this movement up. The movement going up before this failure swing, movement going up, price left fair value gaps here and here. These are fair value gaps that needs to be filled up. So this movement to the downside was done with the intention, with the intent. Now this is simply to tell you that every movement to the market is calculated. It's a series of signatures led by algorithm. Okay, because 90% of trading is being done by algorithm. This algorithm leaves signatures. It is led for you to take note of these signatures led by this algorithm used by the market makers. Okay, now what will bring price down? Bringing price down will be done to cover these fair value gaps. Now, if fair value gaps was cleared, then note that there's also liquidity here that has not been taken out. So price came, took out liquidity. Now, when they got to this other block did not hold this price. Why? Because this liquidity, this other block here has already been mitigated here. So the only other block left unmitigated was this one here. So price came down, mitigated this other block. Then the cause of its movement down, we can see clearly the fair value gaps left here. And whenever I see fair value gaps, I'm always excited because this is money to be made. Because I am certain that price will always return back to fill up those fair value gap. All right. So this is just a simple example of how to read your chart. What differentiates you from other traders is the ability for you to read your chart effectively. That is different between smart money traders and retail traders. That's the reason why retail traders do not make money in the market, because they don't understand what you understand. They don't see the market or read the market the same way you do. We've already talked about trader liquidity. Okay. Now we'll talk about how liquidity grab, which is simply the impulsive movement to take out stop losses. All right, liquidity grabs usually happen with one impulsive move and leaves a large wick behind. Now, this move is simply to take out stop losses. Can either be called liquidity grab, stop hunt, manipulation. Whatever name you call it, they all mean one and the same thing. They mean one and the same thing. All right, okay. Now, the movement done to take out existing stop losses or liquidity is being referred to as liquidity grab, stop hunt. Some tests will refer to it as manipulation. All right, depends on the name between. Now, look at here. We have equal lows here. This is your double bottom, as the case may be. This here is your double bottom. Now, what are the rules of to trade the double bottom? We have a double bottom, you identify your neckline, right? This is the neckline here. Now, this is the neckline. The rule says that you enter your trade with the close of the candlestick above the neckline. Now, this is the candlestick that close above the neckline. That means your entry for buy is right on the close of this bullish candle. When you buy, technically your stop loss will be between here and this low here as your stop loss. And where you have this stop losses, this is where you have the liquidity. Where stop losses are accumulated, this is where the liquidity is, okay? Now, market made a move to the upside. On top of, we'll use a single candle to come down here, then swept off this liquidity. So you can see at the point where the liquidity was taken as stop losses has been hit, price returned back up. This is what is called liquidity grab, liquidity sweep, stop hunt, whatever name you call it, they all mean one and the same thing. Here you have other chart example. You can see price giving us series of equal highs, right? Equal lows. Then what happened? Price first went up, took out the liquidity to the upside, returned back down, took out the one to the downside, made its way up. When it got to the upside, we had equal highs. Equal highs. By the rule of double top, equal highs, this is where you have your neckline. All right, the close below the neckline is this. You have entry on the close of that bearish candle. Stop loss could be anywhere between here and here as your stop loss. So even before now, look at the iron here. Retail traders will sell here. Whereas, whereas smart money traders will sell here. So at the point when this liquidity is being cleared off and the candle closes right here, the smart money traders will already enter the market to sell from this point because they understand the language of the market better. So the art of taking out existing stop losses or existing liquidity, either previous days high or low, previous weeks high or low, initial high or low, equal highs or equal lows, is the process of taking it out or clearing such liquidities, or even that of the trend line, is referred to as liquidity sweep, liquidity grab, stop hunt, whatever name you refer to it, they all mean one and the same thing. Now, some persons cannot differentiate between break of market structure and liquidity grab. Some persons can differentiate between break of market structure and liquidity grab. Now, this is a structure. This high is a structure. This high is a structure. This is a structure. This is a structure. All right. Now, a break of market structure simply means a continuous trend in the direction of the break of structure. When price went up here, it broke the structure. Now, breaking this structure is going to do a retracement. This is a retracement that issues a continuous movement to the upside. The movement up here broke this particular structure. All right, this particular structure has been broken out. We expect to get a retreat about 50% or more retracement that will ignite or pour up another move to the upside. Then this movement up broke this particular structure here. Then a retracement pathway to the previous price area. Then a movement up again to take out or break this structure. So break of market structure is a continuous movement to a trend direction. Whereas liquidity grab is simply the hunt for liquidity, the hunt for stop losses. Now look at what we have here. Here we have equal highs, sorry, equal lows. Equal lows, and this is the liquidity grab. This is a grab or the sweep for liquidity. Here we have another equal lows. And this intentional movement that leaves a wick is the sweep or the grab for this particular liquidity. All right. So that is different between liquidity grab, then break of market structure. Then let's look at what stop hunt means. Stop hunt is simply manipulation for liquidity or manipulation for stop hunt, as a hunt for stop loss. Now, stop hunt is a movement used to neutralize liquidity, that is stop losses. It is a force and intentional breakout above or below the areas or zones where there is liquidity. It is an intentional and a forced movement to take out or neutralize existing liquidities or stop losses. Here's a chart example to explain this. Here we have a previous high. All right. Here we have a previous low. Then this movement down here was a stop hunt that neutralized this low, this liquidity. And price made a move to the upside. This move to the upside neutralized this liquidity here. Move to the upside here, neutralize this liquidity. All right. Here's another chart example. We can see clearly here was an initial low. Then this is the stop hunt that neutralized that. As a stop hunt manipulation that neutralized that particular low. Equal lows, test liquidity, manipulation and neutralize that. Equal highs, the previous high, previous high. This is the stop hunt. Neutralize that. Okay. So stop hunt is simply a manipulated movement geared towards taking out existing stop loss. It's a move in the opposite direction of the trend to take out existing stop loss, otherwise known as liquidity. Okay, so that brings an end to our class today. Today, a review of everything we've talked about today. We've talked about liquidity, liquidity being where we have the accumulation of existing stop losses. Then liquidity will have the buy stop liquidity, which is where you have the stop losses of sell orders accumulated here. Then for sell stop liquidity is where you have the accumulation of buy order, that is stop losses of buy order. They also have the trend line liquidity. Then you should note that as a trader, while you're mapping out your order block, look out for favorable gaps. And as you are doing that, be intentional about liquidity. Be intentional about liquidity. If you don't spot out the liquidity, you will end up being the liquidity. So thank you very much. I remain your trainer, Prosper Okonkwo. Trade profitably with FSPG.